So let's take a look at Walmart. Obviously, a gazillion stores. I think the drawback in some people's minds is that big Walmart comes into these little towns. They force out small business owners. They also employ a lot of people while also bringing very, very low-cost goods to people at a very small profit margin.
If you get upset that Walmart ruins local businesses, I'm all in favor of local business, all in favor, but I don't believe in it as I believe that Walmart employs more and gives more financial benefit to families than paying more at a local business. I'm all in favor of local business, but let's remember there's free markets and all that stuff.
What is the market cap of Walmart? I'm guessing it's like 70 gajillion something?
It's $400 billion.
Wow, okay.
It's a big company. PE ratio is just out of our range, so it's an X there at 20.5. Profit margin, again, just like Target, very low, about 3 or 4%. So that's an X.
We'd like to see this above 10%, but it's okay.
But again, for Walmart, historically, they're around the 4%, 5% range. Dividend here, so we have 2 X's so far. Dividend of 1.5%, which is $6 billion. So they pay in dividends alone $6 billion. So we have to make sure their free cash flow can support that $6 billion. You okay there?
I can't read some of these comments. These people are, I just can't. It wouldn't be fair to the human race to read some of these hilarious comments in the chat. Let's go to revenue growth is pillar number 3. Revenue growth over the past 5 years.
Does Target have MILFs galore? Really? Do I need to start hanging out at Target?
Of course you do.
Okay, sounds good.
You can check out You can check out Paul in the T-shirt aisle. Is what I meant to say, as he's buying an 8th grade T-shirt. Go ahead, Paul. At Target, go ahead. Revenue growth.
Walmart. 482 billion, 524 billion, check mark. Please figure out how many are from new stores versus internal growth. But that's a pretty sizable growth if you ask me for a company that large.
Profit growth over the past 5 years.
Guys, these guys print money. 14.7, 14.9, barely a check mark, but still a check mark. I want to make note. Look at the previous 4 years. 15.7, 17, 16, 16.4. If you invested right here, this goes to show you how things can change. Look at the next 5 years. 14.7, 13.6, 9.9, 6.7, 14.9. So there can be changes over 5-year periods, guys.
Paul, while you bore us with those numbers, the chats are off the chain that the 9th pillar should be Target's year-to-year turnover with MILF growth in the 20-25% range. Maybe you should be hanging out there having your little lunches and get Starbucks there. Yeah, MILF.
They have Starbucks in Target.
The shares outstanding, Paul, is pillar number 5.
3.2 billion down to 2.85, so it's a check mark there. So they are using that extra cash flow to buy back some shares.
So we have positive growth on revenue, profit, and the shares are going down. Pillar number 6 is current assets over current liabilities.
73.6 billion in current assets. 88.1 in current liabilities. So that's an X there. But I'm not worried about it. Walmart's notorious for having their vendors, really be on the skinny about things, so I'm not as worried about that.
Yes, Kenneth, we are waiting on the wrestling match. We're trying to get into some matches with COVID.
The wrestling match is going to take some time to happen, guys, because of this COVID stuff.
Yeah.
But it'll happen.
Free cash flow growth is pillar number 7. We want the free cash flow increasing year to year, Paul.
16 billion, 15 billion.
Wait a minute now.
It's like 14.5, actually.
It's an X for free cash flow growth.
Yeah. 21 billion. 18 billion, 17.4.
Okay, Paul. I just realized that I'm supposed to be getting an
37.
I got it.
35.4, 14.5, 40.
I got 13.8.
87 divided by 5 is 13 point something. You said 8?
Yeah.
So first off, 13.8 billion. So first off, it's an X in growth. 13.8 billion, they pay a $6 billion dividend every year. They're all good there. Multiplied by, I think this is a 15 all day. Even though this is an established company, the growth potential is going to be very limited. They're going to buy back their shares, which is great, but I still think this is a conglomerate that's so large, 15 times is about right for me. So we're looking at 15 times 12 is 180, so call it $200 billion. It's currently at $400 billion.
So not that it matters too much, but of course David S. Punkins called me out because maybe that number was incorrect with free cash flow, but I don't know if it's terribly off. Paul caught me.
What's 87 divided by 5?
87. Sorry, guys. I let you down. It happens in life. I let you down.
Wait a second. That's not right either. Hang on. Let's just do it from the beginning. Ready?
Please do. I'm so sorry, guys.
16 billion.
Thank you.
21 billion. 18.3 billion. Yeah, how'd you get freaking 13?
I did it wrong, and David caught me. He lets nothing pass.
17.4 billion.
He lets nothing pass his clutches.
And 14.5 billion.
Okay, divided by 5, the average free cash flow is 17.5. Thank you, David. I love you.
Times 15. What's that? Multiply that by 15.
Sure, Paul. The free cash flow multiplied by 15 is 262. Is that 2.6 billion or what is that?
No, 262 billion.
Oh my God.
And it's currently 400 billion. So it needs to fall by 35%, 40%, 35%. And by the way, that sounds about right to me. The company's at 25 times PE. You need to have this thing drop significantly. I don't think you should pay a premium for Walmart. I think it's going to be a slower growth company. They're competing very well against Amazon though. They have a faster growth on online sales than Amazon because they're smaller.
And that's a common theme that we're seeing right now. And you would think that with all of this up of the market, a lot of these stocks would be in an uptrend, but they're really not. The thing that I noticed when I really zoomed out here is I was talking about W's and creating higher lows, and this goes for kind of day-to-day trading. But if you look at this chart, as groups of candlesticks, we are creating higher lows as this thing trickles up. So from a trading perspective, Walmart is not a stock that I'm going to typically go short on. There are better companies out there that I can short, but keep a watch on it. If you want to, you could short this thing probably. It might be a little late because I do talk about being inside of the sweet spot, and now you're kind of at the bottom. You're kind of bottom feeding right now, seeing what else you can capture. You want to start that short closer to the 80% and run it down to 32%.
Paul, final take on Walmart.
Just wait. I mean, it's the company that I think should be a staple of everybody's portfolio at the right price. I don't think they're going away. It's going to be very hard for that to happen.